Residual income valuation. The income statement contains a charge for debt cost but not for the cost of equity. And the point here is straightforward. When we come up with an income statement, we have the revenue, we have the different costs, and these costs include the interest that a company pays to providers of debt, and then we come up with a profit. So this profit is calculated after we pay out interest. But what about the cost that is implicitly expected by shareholders? So shareholders expect a cost of equity. This cost of equity is not considered when we calculate the net income. And what this whole method is based on is the concept of residual income, where we calculate the residual income as essentially the profit minus the cost of equity. And there might be a situation where a company is not even generating enough profit to cover the cost of equity, and that issue is highlighted when we use the residual income model. So in this particular reading, we'll start out by talking about the residual income model, and here a key aspect will be to understand the concept of residual income. We'll talk about a single stage and then multi-stage models. We'll also discuss the residual income valuation in relation to other approaches. Segment 5 is about accounting and international considerations, and the last part of this reading is about other accounting considerations. First, the definition of residual income. As I implied on the previous slide, residual income needs to take into account the cost of equity. Our starting point is the net income, and then from the net income which we get from the income statement, we subtract the equity charge, which is the total amount of equity capital. This is the money that has been put in by shareholders multiplied by the cost of equity. Given this definition, I want you to solve this question. This is actually example 1 from the curriculum. So here is what you do. Residual income is net income minus the equity charge. You are given the EBIT. So what is net income? It is from EBIT you subtract the interest. The interest is 1 million into 7%. So the cost of debt is 7%. So actually there's also, you need to do the after-tax cost of debt. So your net income is 91,000. And then what is the residual income? So net income is EBIT minus interest into 1 minus T. EBIT is 200,000. Interest is 1 million into 7% from here into 1 minus T. So this is net income. Then residual income is the net income number minus the equity charge. How much equity do we have here? The equity is 1 million because it's 50% of the 2 million number. Overall residual income is a negative number, minus 29,000. So this means that when we consider the fact that our cost of equity is 10%, we are not doing very well at all. This is one approach. Another approach is to take the overall investor perspective. So if we take EBIT into 1 minus T, this is also sometimes called NOPAT, but then we have to subtract total capital into WACC. So what is the total capital? The total capital is 2 million. The WACC is 8.45%. That is simply the weighted average cost of capital that can easily be computed. And using approach 2, you will get the same answer. So these are just 2 ways of coming up with the same answer. You can either take the money available to shareholders, which is the net income, and then subtract the equity charge, or you can take the money available to all providers of capital and then subtract a charge that is based on the overall cost of capital. Next, we talk about some commercial implementations, and this is a very straightforward concept. Economic value add, or EVA, is a commercial implementation of the residual income concept. What you are looking at here might appear to be a different formula, but this is exactly what we just saw. So EVA is NOPAT, and NOPAT actually is this term over here. So it is EBIT into 1 minus tax rate, that's also called NOPAT, minus this C percent is simply the weighted average cost of capital, and TC is total capital. So it is exactly what we have just talked about. In commercial implementations, what we generally do is take the numbers presented in the financial statements, the income statement, the balance sheet, and make some adjustments. What I have done here is simply reproduced the adjustments that are mentioned in the curriculum. Now, some of these might seem strange, so I will just have you read them and get a general idea. I don't think it is important to try and understand every single detail. Just a couple that I'll highlight. Research and development expenses are capitalized and amortized rather than being expensed. The concept being that R&D is an asset. It is intangible, but it is an asset. It is part of the, in a sense, the capital, the intellectual capital of a company. So this model does consider R&D as an asset. Another point is that any inventory reserve is added back to capital. So a lot of this has to do with also making sure that companies become comparable. So if companies are using LIFO, you add back the LIFO reserve. So essentially you have FIFO inventory, which is more depictive of the current economic reality. Operating leases are treated as capital leases. So you try to remove off-balance sheet financing and try to make it on the balance sheet. So anyway, the key point to remember is that this is the formula for EVA, and in this implementation, some adjustments are made to NOPAT and to total capital. Also, you need to understand the concept of market value add. Market value add is simply the market value of a company minus the book value. Where is the market value coming from? This is the share price multiplied by the number of shares outstanding minus book value. This is from the balance sheet. So a management team that is operating very well, and if a company is operating efficiently, then the market value will be more than book value. The difference is an indication of how much value has been added. That's why this is called market value add. Now I want you to do this example. This is not from the curriculum. It is something I came up with just to illustrate the point that we are talking about. So this is what you do. EVA is 200, which is NOPAT, minus 0.14 into 1400. In this simple example, we have only equity, we don't have debt. If we had debt, then obviously we would have to use the weighted average cost of capital. And then MVA is the total market value of equity minus the book value, which is the total capital in this context. So these are your answers. We will take the concept of residual income and then use that concept to come up with value. And the whole model is summarized over here. The value of a company is equal to the current book value. So if you are valuing at time 0, the value is the book value at time 0 plus the present value of the residual income out into the future forever. So that is what this is. It's taking the residual income at the end of year 1 and discounting it back, then residual income at the end of year 2, discounting back, and so on. So the idea is straightforward. Notice that if residual income for a given period is simply the earnings for that time period minus the equity charge, which is the return on equity or the required return, multiplied by the book value at the start of the period. So make sure you understand the T and the T minus 1. All we are saying is that if you have a given period, so this is period T, then this would be T minus 1. What's the residual income over here? It is the residual income for this period is written as this. Residual income for period T is equal to the earnings for this period minus the required return into the book value at the start of the period, which would be T minus 1. So that is why you have this expression over here. Instead of residual income for period T, we can write the earnings for time T minus required return into book value. Make sure you don't get confused by the fact that E here refers to earnings and B refers to book value. If you start confusing E for equity, then that will be a problem. Okay, so remember E is earnings. All right, now let's work through this. I want you to read this. We are going to come up with the residual income for 2 years, 2007 and 2008. You read this, I'll then help you come up with the numbers for 07, and then you'll have to come up with the numbers for 08. So the first thing we'll do is calculate the residual income for the first year. The first year ends December 2007, so I've marked a 1 over here because we will call that year 1. The book value at the start of year 1, which is end of 2006, is 13.46. That's given right here. We are given the expected earnings for 2007 equal to 2.71. That's given right here. The residual income is the net income for the first year, 2.71, minus the required return on equity of 9.3%, which is given over here. They have done the calculation graciously for us. It's 0.093. So 0.093 into the book value at the start of the period. So you do the calculation and you come up with residual income equal to 1.46. What is the value, the book value at the end of the first year? So try doing that now. So to come up with the book value at the end of year 1, you take book value at the start, 13.46, plus the earnings for the year, 2.71, minus the dividend for the year, 1.03, and you come up with 15.14. Now pause the video and do the same exercise for 08. And here is what you will come up with. The beginning book value is 15.14. That's what we just calculated. You add the earnings, subtract the dividends, and you come up with 16.94 as the book value at the end, and your residual income per share is 1.45. The same logic applies. You have the earnings for the period minus the equity charge times the book value at the start of the period, start of period 2, which is end of period 1. What we have done in example 2 is figured out how to forecast residual income. Now in example 3, we will use residual income numbers to come up with the value of a stock. So try doing this, and here is the formula that we have talked about for value. So here is what you do. This is the first step. You are given the beginning book value per share. You are given the net income for year 1. You are given the dividends for year 1. So the change in retained earnings is 2 minus 1, which is 1. Ending book value is 7. Net income per share is given. The equity charge is R times the initial book value, and that is 0.6. This is because your equity charge is 10%. This would be 10% of the book value at the start. So your residual income for year 1 is 1.4. Using the same logic in subsequent years, you can come up with the residual income for year 2 and year 3. Then the value of a company using the residual income model is the initial book value, which is 6, plus the present value of all subsequent residual income numbers. And you do the maths and you come up with 11.15. This example points out that as long as your assumptions are consistent and you have clean surplus accounting, which is something I'll talk about later, then the dividend discount approach will also give you the same number. If you take all the dividends and discount the dividends back at the cost of equity, which is 10%, you will also get 11.15%. There are two important points illustrated in this example. The first one is that the residual income model is fundamentally similar to other valuation models, such as the dividend discount model, and given consistent assumptions will yield equivalent results. The other point is that recognition of value typically occurs earlier in residual income model. Recognition of value typically occurs earlier in residual income models relative to DDM models. With DDM models, you have to make assumptions about what will happen in the future, and a significant component of your value is the present value of the terminal value. And that is heavily dependent on assumptions such as the growth rate. Whereas if you look at the residual income model, a large part of 11.5 is coming based on your book value, which is today. So put this in your head. This concept will come later, and I think that if you are tested on residual income on your exam, then this concept is probably likely to be tested. All right, the generic residual income model. So what is the generic model? First, let's just read this high-level remark. The residual income model has a clear relationship to other valuation models such as the DDM. We are actually going to show that if we start with the dividend discount model, then we can end up with the residual income model. So this should be very familiar. This is saying that the value of a company is the present value of all the dividends. If we have clean surplus accounting, and you might recall this, I'll mention the point here briefly and then we'll talk about this in more detail later. Clean surplus accounting means that all gains flow through the income statement. In other words, you are not going to do things like available for sale securities where a gain to equity happens without passing through the income statement. So in clean surplus accounting, all gains to equity flow through the income statement and retained earnings. So if we have clean surplus accounting, then the book value at the end of a given period T is equal to the book value at the start of the period plus the earnings minus the dividends. So this is your clean surplus accounting. If this relationship holds, then what is D equal to? Then D is simply equal to BT minus 1 plus E minus BT. So when we plug in the value for D1, you will have E1 plus B0 minus B1, and you can do the same. So this relationship is simply based on taking the dividend discount model, adding this, plugging in, and then you get this relationship. Then notice if you take this expression over here, E1 plus B0 minus B1, using basic algebra, this can be written as E1 minus B1 minus B0, and then this can be written as E1 minus B1 minus B0 is the change in book value. So the change in book value is simply the required return into the book value at the start of the period. So using this, we then plug in and get this expression. And this then is nothing but residual income. So we have used our dividend discount model as a starting point, and we have ended up with this relationship that the value at time 0 is the book value at time 0 plus the present value of all future residual incomes. When we use the summation sign, this can then be written like this with summation. So these two relationships essentially are equivalent. You can either just write residual income or you can have the expanded form of residual income. I also want you to notice that the earnings minus R into B is the same as this expression over here, and I'll just do it for you once and then you can remember this particular relationship. It is important. So what we are saying is the following, that over a given period, if this is time t, the earnings at time t minus R into book value at the start of the period can also be written like this. What is return on equity for a given period? Return on equity for time period t, if you think about this, ROE for time t is equal to the earnings for time t divided by the book value at the start of the period. So what is ET then? ET is simply ROE at time t into book value at t minus 1. So you can plug that in over here, ROE at time t times book value at t minus 1, and then you have minus R into BT minus 1. So then you can simply pull out BT minus 1 and you have ROE minus R, which is this expression over here. So there are three ways then of writing the same thing. Your value is equal to book value plus the summation of the present value of all residual incomes. Residual income can be written like this, and residual income can also be written like this. The difference between ROE and the required return multiplied by the book value at the start of the period. So you can either derive the three or you can just memorize all three. Now this is the same question that we saw earlier in example 3. I'm not going to make you do this, but recognize that this is an expression that we just saw, and when we actually plug in the numbers, if we come up with ROE minus R, that will give us these numbers, and you come up with the present value. The value is the same because we've algebraically shown that the expressions are equivalent. Fundamental determinants of residual income. So if we assume constant growth, up till now we've not made any assumption about growth. We've just said that we look at all the residual income numbers in the future and then come up with the present value. What if you have growth? Then what do? Then we can use this as a starting point. Do you remember this relationship from the previous reading? So price to book value is ROE minus G over R minus G. This can then be written like this. So ROE minus G can simply be algebraically written like this, which then can be written like this. The value at time 0 is B naught plus this relationship. Now I want to emphasize a few points over here. What does ROE mean? ROE is the return on equity. So will good profitable companies have relatively high ROE? So profitable companies will have high ROE relative to the required return. So companies with high ROE relative to required return will have a high residual income. So that should make intuitive sense. If ROE is equal to the required return, then what's the residual income? 0. So if a company is not making any economic profit, in the sense that after your equity charge there is nothing left, then that means residual income is 0. If ROE is more than R, that means that there is some residual income. So one major driver of residual income or value is the difference between ROE and R. The other, as always, is G. So if our earnings and dividends are growing at a rate G, then that also means that the value is relatively high. This is something that is not explicitly mentioned in the learning objectives, but it is in the curriculum, so I'll quickly mention it. There is a ratio called Tobin skew, which is the market value of debt and equity divided by the replacement cost of total assets. So just try to remember this, and I would suggest that you quickly read through this. It is fairly straightforward. All right, single stage residual income valuation. So before I solve this, I want you to quickly try and answer this question. Example 6. So here is what you do. This is the formula that we just talked about. All the numbers are given. You plug in the numbers and the value is 50.16. If the current price per share is 51.9, then what is the implied growth rate? And you've seen this over and over, starting with the reading on dividend discount valuation. All you do then is, in the same formula, you plug in 51.9 instead of the value, and you plug in all other numbers. G is unknown, and you can come up with the implied value of G. If you do this, you should come up with 8.16%. So it is just simple algebra using the same equation. All right, multi-stage residual income valuation. Now, when you do multi-stage valuation, you as an analyst might make one of many assumptions. Residual income continues indefinitely at a positive level. So this is one sort of assumption. Another assumption is that residual income is zero from the terminal year forward. Or you might say that residual income declines to zero as ROE reverts to cost of equity. Or you might say that residual income comes to some value of ROE, which is not necessarily the same as the required return. Under what circumstances will you have scenario 1? You might have this for a company that has a sustainable competitive advantage. In a market where there is high competition, you are likely to have this scenario 3, where the ROE will come down to the required return. So how do you do valuation? The concept again is straightforward. The value at time 0, always the starting point is the book value at time 0. And hopefully you see this with residual income. The starting point is from your balance sheet. You take your initial book value. Then over a given period of time, you take the residual income. Let's say that T is 3, just as an example. So what does this mean? This means that you have 1, 2, 3. This is time 0. You are doing your valuation at time 0. What's the first thing to do? Take the book value. Then you come up with the residual income for year 1 and come up with the present value of that, residual income for year 2 and present value, residual income for year 3 and the present value. Then at the end of year 3, which is T in our example, you then come up with what is called the premium over book value. So this is roughly like a terminal value. You say, what is the price per share going to be at the end of year 3 minus the book value that you expect at the end of year 3. So this is the premium. You estimate that premium. Obviously, if you expect the company to have a substantial competitive advantage or a relatively high ROE, then this premium will be big. If you expect that at this stage, the ROE is equal to R, then what will the premium be? Then it will be 0. In any case, you estimate this premium and then discount the premium back. How is this formula different? This is something we've talked about, that your residual income can also be written in terms of ROE minus R into the book value at the start of the period. Now this is example 8 from the curriculum, and I normally have you do the examples. This is such a long example that I don't want you to actually do it, but I do want you to understand what is going on. On the exam, you will not get something that spans 20 years, but this concept is very important. We have our analyst, Diana Rosato, and another reason I'm mentioning this example is that this continues and illustrates several important points later. So a company is being evaluated, a semiconductor company in Taiwan. With these examples, or whenever you are doing these questions, it's important to understand where in time you are currently standing. So the company's stock is also traded. In any case, this is information as of early 2007. So you are here in let's say Jan 2007. You have the current stock price, the cost of equity is given. So the R is 15%, that's given. You are also told that the ROE has ranged between these two numbers. So you can read through the rest of this information over here. I am going to actually move forward to the next slide and just illustrate the main point. So this estimate is done from 2007 till the end of 2006. Now what is happening for every year? In 2006, so remember where are we standing? We are standing here in Jan 07. We are given the book value at the start of Jan 07. So that number is given. Then we are also given the projected income in Taiwanese dollars for 07. We are given the expected dividend. Based on the income and the book value, we also know the return on equity in percentage terms. The COE is the cost of equity, which is 15%, that's given. The COE TWD, this is the cost of equity in currency, in Taiwanese dollars. How do we come up with that? It's simply the 15% multiplied by the equity at the start of the period. Then can we come up with residual income? It is simply the income, accounting income for the year minus the equity charge. And then we can come up with present value. So if we have a spreadsheet, we can do the same analysis for 2007, 8, all the way till the end of 2006. So we can come up with all these residual income numbers and the present value. We also have the book value at the start of the period. If we assume that at the end of 2006 the total premium is 0, why are we assuming this? Because we are saying that by 2026 this will be a mature, totally mature company, no competitive advantage. ROE will be R, will be the same as R, so premium 0. So how do you come up with the value of the firm? The value of the firm is the initial book value plus the present value of all these numbers. All right, then example 9 builds on this, and all example 9 is saying is that at the end of 2026, what if the premium is not 0? Okay, so the manager or the supervisor here says that let's say that at the end of 2026, if the residual income is this number, let's assume that this residual income will stay for whatever reason. The supervisor thinks that there's some competitive advantage which will remain and ROE will remain above R. Then what do? Then what we can say is, if for 2006 onwards, the residual income is 13.65, then this effectively is a perpetuity. So how do you come up with the present value of a perpetuity? You take that number and divide by the cost of equity. So you will come up with a number, and then you discount that number back to the present. Will that add to the value of the entity that you are valuing? It will. So this number gets added to what you are valuing. And this commentary over here is simply saying that the valuation that the analyst is coming up with is different from the market price. So the current market price is 62, which is greater than the valuation number coming up here. So this particular stock appears to be overpriced. Okay, now an interesting twist. Do you think that if there is a difference between ROE and R, so there is some residual income, will that suddenly go to 0? or is there a chance that that slowly goes down to 0? So it is likely that if there is some residual income at your terminal year, then that slowly goes down. A measure for how fast or how slowly the residual income goes down is the persistence factor, which is represented by the symbol omega. This might be anywhere from 0 to 1. If the persistence factor is 1, then the residual income will not fade at all. If the persistence factor is 0, then the residual income will not continue. In other words, it will fade to 0 immediately. So let's see what this means. Here is the formula, and I hope that at least the first three elements here are familiar. The value at time 0 is book value, plus what are these numbers? These are simply the residual income numbers. So to make this straightforward, let's say that T is equal to 4 in this formula. And let us say that we are going to use different values for persistence. So pay careful attention now, because if you understand this, you can save a lot of time. So we are saying this is time 0, and we are going to find the value at time 0. This is time 1, 2, and 3. Notice that if T is equal to 4, then over here we go till T minus 1, and you will understand why. For the end of period 1, what do you do here? You find the residual income for period 1. So residual income for period 1 and discount it back. Then you find residual income for period 2 and discount back. Then you find residual income for period 3 and discount back. Then what do you do? For period 4, this then kicks in. Let us say that the residual income for period 4, is this residual income for period 4? If T is equal to 4, then this is the residual income for period 4. Let's just say for simplicity that the residual income for period 4 is equal to 6. I'm just picking a number. All right, then what do we do? Now the question is, how fast will this 6 come down to 0? If it will never come down to 0, that whatever is causing the residual income to be 6, if it will stay at 6, then what is the persistence factor? Then the persistence factor is 1. Persistence factor of 1 means that this residual income of 6 will stay. Now, without even looking at this formula, if the persistence is 1, then what is the present value of the residual income? The present value of this perpetuity is equal to the residual income at time 4, which is 6, divided by the discount rate, which is R. Right? And then we will take this and discount it back. So effectively you have the 6, which is the residual income for period 4. So what does this become? This becomes 6 over R, and then that number needs to be discounted back how many periods? From here, 3 periods. So basic present value calculations that you can do in your sleep now, I hope. So 1 plus R to the power of 3 being T minus 1. Now notice that is exactly what this is saying. If you plug in persistence of 1, then what do you end up with? You end up with the residual income for period 4 divided by R, because if omega is 1, persistence factor is 1, then 1 minus 1 becomes 0, and you are left with R. And then what does this do? 1 plus R to the power of 3. This is simply taking the number over here and discounting back. Now let's take the other extreme. What if persistence is 0? If persistence is 0, then what do you have? Then you have this number 6, the residual income for the 4th period, divided by 1 plus R. So you are simply discounting 6 back 1 period, and then that number is being discounted back to time 0. So with persistence equal to 0, you are assuming that there is no residual income afterwards. What if persistence is 0.5? Then you will get an answer that is somewhere in between these two, and you will have 1 plus R minus 0.5. So If the persistence number is high, then the value that you will get will be high. If the persistence number is 0, then you simply have the present value of 6. Now, what are the characteristics which indicate high or low levels of persistence? When will you have low residual income persistence? If ROE is abnormally high, then persistence will be low because ROE will come down. If you have special items, just one-off items that are maybe causing the earnings to be high in the short run, then also persistence will be low. If there are very high levels of accounting accruals, then also the persistence will be low. When will you have high persistence? If the payout ratio is low, which means a lot of money is being reinvested, or there is generally high historical persistence in the industry, and not explicitly mentioned here in the curriculum, but if a company has a competitive advantage which gives it a high ROE, then that also will result in a higher persistence number. All right, now the same example that we have been talking about earlier, you can probably see where this is coming from. It's the formula that I've just described. Hopefully you remember this formula. In this formula, I'm going to write it down again for you. V naught is equal to B naught, plus there is one term that is simply saying it's the present value of all your residuals, and then the third term is this one, which is your residual income divided by 1 plus r to the power of t minus 1, and then 1 plus r minus omega. If we say that omega is 0.6, then you just plug in the 0.6 and come up with the present value. So the calculation is fairly straightforward. Now I want you to do this example. So this is quite indicative of what you might come up with on the exam. This example is not in the curriculum, it's just something I came up with. So here's how you do this. So you are here, end of 2013, the book value is given. So book value end of 2013, start of 2014 is 15 per share. And then we are told that the premium over book value at end of year 3 over here is 25%, which means if we find this book value, then the price will be 25% more than that. So I did this on Excel. So this is year 1, net income 2.1. Where do you think this is coming from? So we are told that the ROE is 14%. So 14% into the starting book value, that's net income. Since dividend is 0, the ending book value is 17.1, and then ROE is 14% consistently. What is the equity charge? It is 10% of book value at the start. So this worked out very nicely in Excel. And then the residual income is simply the difference. And then here we come up with the present value of the residual income. We do the same for year 2 and also the same thing for year 3. But for end of year 3, we need to do one more thing. We need to calculate the premium. What is the premium? It is the book value at the end of year 3, which is 22.22, multiplied by this 25% premium. So that gives us a number, and the present value of that number is 4.17. So what is the value at time 0? It is the initial book value of 15 plus the present value of residual incomes for year 1, 2 and 3 plus 4.17. All right, we are coming close to the end of this particular reading. Residual income valuation in relation to other approaches. We've already talked about this, but I have formally taken out the most important points over here. Discounted dividend and free cash flow models forecast future cash flows and find the value of a stock by discounting those cash flows back to the present value using the required return. With dividends, we will discount at the cost of equity. With free cash flow, we will discount at the weighted average cost of capital. The residual income model starts with a value based on the balance sheet, which is the book value of equity, and adjusts this value by adding the present value of expected future cash flows. So the approach is different. With dividend discount models and so on, you in a way work backwards, because if you think about it, a large part of the value is coming based on the present value of the terminal value. Whereas with the residual income model, you start with the book value at time zero and then you add. In theory, the total present value when using expected dividends, expected free cash flow, or book value plus expected residual income should be consistent. And I'm not going to cover this, but if you have time, you can read through example 11, which illustrates this. But that doesn't necessarily happen in practice. In practice, a large fraction of a stock's total present value in either the dividend discount model or free cash flow model is represented by the present value of the expected terminal value. Substantial uncertainty, however, often surrounds that terminal value. And we've seen this in our sensitivity analysis. Even a 0.5% change in growth rate has a huge impact on the terminal value. In contrast, residual income valuations typically are less sensitive to terminal value estimates. All right, strengths and weaknesses of the residual income model, these are fairly self-evident, and we have in a way pointed these out. What are the big strengths? Terminal values do not make up a large portion of the present value. In fact, the large portion comes from the current book value. Residual income models use readily available accounting data. The models can be applied to non-dividend paying companies or companies that have negative cash flows. The models have an appealing focus on economic profitability. What does this mean? That economic profit is actually your profit minus the opportunity cost, which in this context is the cost of equity. What are the weaknesses? Accounting data prone to manipulation by management. Anytime you are using accounting data, then the question is, how good is this accounting data? Significant adjustments to accounting data may be needed, and in section 5 we will talk about the sorts of adjustments. The clean surplus condition may not hold, and again we'll talk about this in the next section, but an underlying assumption of the residual income model is that all changes in equity flow through the income statement. If that is not happening, then we need to make some adjustments. The model assumes that cost of debt capital is reflected by the interest expense. If it is reflected, that's good. If not, then we have a violation of this assumption. All right, what are the broad guidelines for when to use the residual income model? And this is very testable in my opinion. We've seen this before also. You use the residual income model for companies which do not pay dividends, or if the dividends are not predictable, companies' free cash flows are negative within the forecast horizon, or there is uncertainty in forecasting terminal value using other present value approaches. So you use the residual income model in these circumstances. When do you not use this model? If there are significant departures from clean surplus accounting. Why do we say significant departures? Because if there are a few minor departures, then we can adjust. And if the key determinants such as book value and ROE are not easily predictable, then obviously this model does not work. We now come to the last section of this reading, which is section 5, Accounting and International Considerations. The main point here is that when you are using the residual income model, obviously you need to come up with estimates of residual income. And as you've seen, the calculation of residual income depends on the financial statements. So obviously there'll be places where you need to make adjustments to the information that you extract from financial statements. Most of this section is about the sorts of adjustments that need to be made. And clearly, you also need to look out for aggressive accounting practices, because that will impact net income and obviously equity. And then section 5.6 deals with international considerations. In other words, whether it is appropriate to apply this model across different countries. Let's start with what I think is extremely important in this context, which is violations of the clean surplus relationship. One of the assumptions in using the residual income model is that the clean surplus relationship holds. And let us just refresh our memory here. What is the clean surplus relationship? This is the relationship which says that all changes in equity flow through the income statement. In other words, if you have a given period, then the book value at the end of the period should be based on the book value at the start of the period plus the earnings which are coming from the income statement minus the dividends. If this doesn't hold, that means we have a violation of the clean surplus relationship. And then what do you as an analyst need to do if there is a violation? Then you need to understand how much of the equity or the change in equity is attributed to other comprehensive income. And I hope you remember this relationship from level 1, where we learned that the overall comprehensive income is equal to other comprehensive income plus net income. Net income obviously is coming from the income statement. OCI represents the changes in equity that are not flowing through the income statement. So where do you find this? You can study the equity part of the balance sheet. You can study the statement of changes in shareholder equity to understand OCI. And I hope you also recall from before, there are some classic reasons or there are classic items that are contained within OCI, such as unrealized gain on AFS securities, foreign currency translation adjustments, certain pension adjustments go through OCI, fair value changes of some financial instruments also flow through OCI. At level 1, you understood this first item. In level 2, in the FRA part of the curriculum, you have also learnt about these other items. So let's say you identify these items which are contributing to equity. What do? You then need to adjust the income. So when you calculate residual income, which is the income minus the equity charge, what do you think you should use here? The income from the income statement or the adjusted income after taking into account these items? You actually need to adjust the income to take into account these items. Do you need to change equity? Not really, because these items have already impacted equity. Will ROE be impacted? Yes, because ROE is the income divided by equity. So even if equity is not being impacted, but net income is being impacted by your adjustments, that means you will have to use an adjusted value for ROE. So that's the point made over here. If you have time, go over examples 12 and 13. They are fairly long-winded. So key point is to understand what I have said over here and look at the examples, as I said, if you have time. Next point has to do with balance sheet adjustments for fair value. And this is fairly straightforward. What you as an analyst need to do is identify and scrutinize off-balance sheet assets and liabilities, because these can have an impact on equity. Book value and income should be adjusted for fair values of all assets and liabilities, including off-balance sheet items. So you need to look at inventory, deferred taxes, operating leases, special purpose entities, reserves and allowances, intangible assets. So this is obviously not an exhaustive list. The principle here is that since so much of your process here, the process of coming up with a value, represents on numbers that you are extracting from the financial statements, to whatever extent possible, you need to adjust numbers so that they reflect fair value. Next point, intangible assets. Intangible assets are often not recognized as assets unless they are obtained in an acquisition. But intangible assets have a significant impact on book value and therefore must be carefully analyzed. So this might sound a little different from what you have seen before, but clearly if a company has grown organically and it has spent a lot on, let's say, advertising and brand building, those advertising costs will keep showing up as expenses. But if the company is building a brand, it will have goodwill. Will that goodwill be reflected in the books of the company? No. But that goodwill clearly should be reflected in the book value when you are coming up with the value of the entity. So to whatever extent you can, you need to try and estimate that goodwill and add it to your values that you are getting from the balance sheet. Now, this might sound strange because there are other readings where we have talked about the fact that we just look at tangible assets. But if you think about the context of residual income valuation, you are valuing based on book values. So if we are making fair value adjustments, then to whatever extent possible, we also need to add the intangibles. So goodwill is one type of intangible. What if the company has developed a patent internally and that patent clearly has value, but it is not shown on the books? What should we as analysts do? Should we add the value of that intangible item? Yes. So if there are any identifiable intangible assets which we can value, then we should value them and show them as assets, because that obviously will impact the equity of the entity. Adjust book value to reflect identifiable intangible assets. A tricky one is R&D. So the curriculum doesn't make a clear-cut point about what to do with R&D, and the reason is that it really depends on the productivity or the value of the R&D work being done. If you think about it, lots of entities, lots of companies engage in R&D work, but what is the productivity of the R&D? If a company is doing R&D which is extremely productive, will that cause the ROE and the residual income to be relatively high in the future? Yes. If the R&D is not very productive at all, then will that have an impact in the future? Much less so. Therefore, this is tricky, but you as an analyst need to figure out what is the impact of the R&D going to be in the future. And the way you do that is that you try to assess the productivity of the current R&D work. If the productivity is high, then you can make adjustments that reflect the fact that future residual income is relatively high. If you believe that the R&D is not at all productive, then you should not make any adjustments. Next point is non-recurring items, and you know this already. Companies often report non-recurring charges as part of earnings, and where do you see this? You can look for unusual items, extraordinary items, which is a US GAAP concept. Restructuring charges are generally non-recurring. Discontinued operations, accounting changes. So when you look at these non-recurring items, what do? Your estimates of future residual income should exclude non-recurring items. Do you need to make any adjustments to book value or equity? Not really, because equity is what it is after these items. So key point is that the residual income projections in the future should be based on what is sustainable. Any non-recurring items should not be impacting your estimates of residual income. Other aggressive accounting practices, nothing new over here. These are items that you have seen earlier in FRA, and think of this as a revision. I'll just read out these points. Companies may engage in accounting practices that result in overstatement of assets, which would increase equity, and or overstatement of earnings. These have been discussed earlier in FRA. Companies may engage in accelerating revenue. This will artificially inflate earnings in the current period. So companies might ship unordered goods to customers at year end, recording revenue and receivable. So you as an analyst need to look out for whether a company is doing this or not, because that then will impact your estimates of residual income. Companies can also have cookie jar reserves. You might recall a level 1 FRA case on Sunbeam, which was engaging in this sort of activity where they were artificially writing down so that in subsequent quarters they could show higher earnings numbers. So again, you as an analyst need to watch out for what a company is doing. International considerations. Obviously, if you are evaluating companies in different parts of the world that are following different accounting standards, then to do that comparison, you need to make sure that you have the same base. In other words, if you are comparing a US GAAP company with an IFRS company and you are coming up with residual income estimates, you need to first bring both to IFRS, for example. So that's one point. The larger point made in section 5.6 is that when you are doing residual income valuation, no matter what part of the world you are dealing with, these are three important characteristics that determine the value of your residual income analysis. The first is the availability of reliable earnings forecasts. Clearly, your residual income estimates depend on how good your estimates of earnings are. So if you are in an environment where it is very hard to predict earnings, then it will be hard to use the residual income model. Violations of clean surplus assumption. If you are in an environment where there are lots of violations of the clean surplus relationship and it is not easy to make the necessary adjustments, then obviously that will impact your ability to use the residual income model. And finally, quality of earnings. Again, if the quality of earnings is not good, then clearly you cannot use the residual income model. All right, a quick summary of the most important points now. You need to know this relationship. What is residual income? It is the net income minus the capital charge for equity, which is the equity capital at the start of the period times the cost of equity. And I don't have it here yet, but clearly the net income and the equity capital should be after adjustments. This is another version of the same relationship where rather than looking at an equity perspective, we look at an overall investor perspective. So the EVA or enterprise value add is the NOPAT, net operating profit after tax. This is the money available to bondholders and shareholders minus the cost of capital, the weighted average cost of capital times the total capital, which has been obviously provided by all suppliers of capital. You come up with your estimates of residual income. Then to estimate the value of the company, you start with the initial book value and then the present value of all your residual income projections. Residual income can also be written like this, which is simply the relationship we saw up here. And we demonstrated algebraically that this can also be written as ROE minus R into book value at the start of the period. So also note here, this relationship clearly shows that if the return on equity is higher than the cost of equity, then the company is adding a lot of value and therefore the residual income will be high. For a company that has ROE equal to the cost of equity, for that company there will be no residual income. This relationship then simply says that you can estimate your residual income till a certain point in time, let's say time t, and then at time t you need to come up with this premium number. So what will the share price be relative to book value? Either this number will directly be given to you, that the estimated book value at the end is some number, let's say estimated book value is 100 and PT you might be told is 120. So that extra 20 effectively is the present value of the residual income from time t forward. We also talked about this relationship, which includes this persistence factor, which implied that after time t, the ROE slowly comes down, or the residual income slowly comes down. A persistence number of 1 means that the ROE will constantly remain above the cost of equity. A persistence factor of 0 means that after the terminal year, the ROE will come straight down to the cost of equity, or in other words, the residual income will, after this period, just come down to 0. You need to understand the strengths and weaknesses of the residual income model. The big strength is that this model relies on accounting data. Actually, that can be a strength and a weakness. So actually, the larger point is that when you come up with the value using the residual income model, most of the percentage or most of this value is really coming from the current financial information. So you do not have to rely too much on forecasts, unlike other present value models. So unlike the free cash flow model, where a large part of the value is coming based on the present value of the terminal value. So that is a strength. Another strength is that you can use this model even when earnings are negative or the free cash flow is negative in the short run. This still works. When do you use the residual income model? You use this model when you have high faith in the accounting numbers, when there is a reasonable amount of predictability in terms of earnings, when you do not have major violations in the clean surplus relationship. So that is where you use this. Obviously also, if the earnings are negative or the free cash flow is negative in the foreseeable future, then also you will be inclined to use this model. How do you evaluate a stock based on the RI or the residual income model? This is fairly straightforward. Like all other models, what you do is you come up with the value based on the model, and then you compare that value with the market price. And you will notice across equity that in all our models, we are then comparing the value with the market price. In the discussion on multiples, we compare the multiple that is justified by the fundamentals or justified by the comparables with the actual market PE. And then finally, accounting considerations are important because clearly this model relies heavily on accounting numbers. So the summary point with regards to accounting considerations is that you need to make adjustments when there are violations of the clean surplus relationship. You need to make adjustments so that values represent fair value. And once you can do that, then you can have more faith in the residual income model. That is it for this reading.